Yes, guys, it's another great time. So we are going to do this introduction to a new semester. So it has been time since we met in the last sessions, in our last classes, which we did. So remember that now we are starting a new journey towards the preparations of the August exams. So guys, what I would like to request is that the first thing we are supposed to do, even before I mention anything for the day, first, as a follower of my videos, give me a subscription. In 5 seconds, that is 1, 2, 3, 4, 5. Make sure that you subscribe to this channel so that at least we can grow. So we are heading to 10,000 subscribers. So remember that we can achieve this. We can achieve this. So as I give time for more people to join, make sure that you use these few minutes to give me a subscription. To give me a subscription. So I can see that members are joining. So I'm giving out a few minutes for the guys who will be following to join, then we start. I will be doing financial reporting and analysis question 2. That is a consolidation, and at the same time, I will be able to show you how that question was marked. So members, I'm starting. So just in a few, I will be starting. Make sure that you subscribe, and share the link to the groups. Share the links to the groups so that many students will be able to follow this live session. So I'm starting in a few. I'm giving time, at least members who would be following to join. As I also request that you share this link to the groups, the relevant groups for accounting, whoever is following, make sure that you share the link to other groups. So I will be starting shortly. So we are going to do a question of financial reporting and analysis. Financial reporting and analysis, question 2. That is April 2023. That is just the sitting which you did the other day for the exam which has not been released. So that is what I'm going to do today. So I will be doing that question 2. So for the few minutes I've given, I'll say that make sure that you share the link so that many students will be able to join. As we start. Anyway, I think now we can be able to start. I have said that this is a journey we have started towards the new semester. That is for the August exam. Remember that I will be doing live sessions in YouTube, and at the same time, there is a Zoom classes I do. The online classes during the evening hours. We do Zoom classes. So for you to join, remember that this classes starts 8 p.m. to 10 p.m. So for all the units. But on my case, you know that I concentrate most with the FAR, advanced financial reporting, financial accounting, leadership and management. But also I have a team which covers the other units for the CPA. So you can enroll whichever unit you want. But I will be handling this personally. So for you to be able to join these classes, remember that you can be able to contact me through this number. So you can be able to contact me through this number. That is so that is the number. So 0726. You know that my name is Edwin Ochei. So for you to be able to join my classes, the online one, for all of the units, I've said that personally, I will be able to handle 4 units: financial reporting, advanced financial reporting, financial accounting, leadership and management. But at the same time, I have colleagues for the other units. I have a team for the other units. So if you want to enroll for whichever unit you want, you can just give me a call. Through this number. So to the agenda of today, I would like to look at sitting. That is April 2023. I would like to look at April 2023. This exam is yet to be released. So April 2023, financial reporting, question 2. So it's a question of consolidation. That is group accounting. It's a question of consolidation. Whoever is seeing me online and trying to call, stop that. So consolidation. So the group accounting. Remember that it's called group accounting. So question 2. So this question was having 20 marks. And it was very easy to get that 20 marks. Remember, once you get 20 marks, you need only 30 to pass, meaning that you need 1 question plus theory. You need 1 question plus a theory question for you to excel. So this is the relevant question for that sitting. I will be able to display that question. We interpret it one by one. Then after that, I will be able to present the statement which was required by the examiner. And at the same time, I will be able to show you, or I will be able to tell you how they marked that question. It was very easy question, which was supposed to make you excel in this paper of financial reporting and analysis. So it reads that Liver Limited operates in a fast-moving goods subsector. During the year ended 31st March 2023, River Limited expanded its operations by acquiring a controlling interest in Sai Limited and a significant influence over the activities of Tutu Limited. So once you see that, once you see this word significant influence, it means that the parent never controlled Tutu, meaning that the percentage he acquired in Tutu is less than 50. meaning that Tutu automatically will be an associate to us, that is to River Limited. So, but for Sai, he has a controlling interest, meaning that Sai is a subsidiary. The parent controls subsidiaries, but parent doesn't have a control in associates or joint ventures. He has a significant influence in joint ventures and associates. So the following draft financial statements for the year ended 31st March 2023 relate to the three companies. So we have the statement of profit or loss provided there, and we have the statement of financial position as given below. Then there's this additional information. Number one, it reads on 1st July 2022, River Limited acquired 80% ordinary share holding in Sai for a cash consideration of 1,100. Automatically, we know that once the parent has a controlling interest, has a control of more than 51 in another company, the other entity will be called a subsidiary, meaning that River acquired 80%. So 80% is more than 51 in Sai. So meaning that Sai is a subsidiary to River. So he paid 1,100. So the fair value of the assets and liabilities of Sai were equal to their carrying amounts as at the date of acquisition. So I can speak about that sentence whereby they are saying that the fair value was equal to the carrying amount. What if there was a difference? Fair value equal carrying amount. Equal carrying amount. What does that mean on this case when the fair value equals the carrying amount? Or what if there was a difference? So there's something called revaluation. Here we don't have revaluation, no revaluation, no revaluation. So we only have revaluation if there's a difference between the fair value and the carrying amount. If there's the difference between the fair value and the carrying amount. But on this case, the fair value of the assets and liabilities were equal to their carrying amounts, meaning that there is no what? Revaluation. There's no revaluation. There's no revaluation. There's no revaluation. Assets and liabilities of Sai. Number two, the group policy is to measure the non-controlling interest at their proportionate share of net assets of the subsidiary at the date of acquisition. As at the date of acquisition. What does this mean? Number two, that the group's policy is to measure the non-controlling interest at their proportionate share of net assets, as at, that is at their proportionate share of net assets of the subsidiary at the date of acquisition. So what they mean is this, there's something called goodwill we'll be doing. There's something we call goodwill according to IFRS 3. So when doing goodwill, you can either use full method or partial. You can either use full method or partial method or a partial method. You can either use the two. But now, given that statement, number two, it means that we go for the full method. Given that statement that the NCI is done what? It's measured at its proportionate something, as they say anyway, according to that note too. So when they are talking about the NCI being what? I can be able to display. They say the group's policy is to measure the non-controlling interest at the proportionate share of net assets of the subsidiary as at the date of acquisition. When I will be doing goodwill, when the parent will be doing the goodwill of the subsidiary, it will go for the full method. Number three, on 1st January 2023, River Limited acquired a 40% ordinary shareholding in Tutu for a cash consideration of shillings 500. So it implies that Tutu is an associate. The 40% interest, the 40% interest, it means that River doesn't have control in Tutu, but it has something we call significant influence because Tutu is an associate. When we will be accounting for the associates, we use equity method. I will be able to show you how we do that. That is according to the relevant IFRSs. Not IFRS, IAS. IAS 28, to be more specific. International Accounting Standards 28. When accounting for the associates, we use equity method. Number 4, during the post-acquisition period, River Limited sold goods to SAI for 300. River Limited reported a 20% profit margin on this sale. So there's goods sold from River to SAI. When River was selling these goods, he reported a profit of 20%. But now, did SAI resell the goods he received from River? There are sentences in note 4 says, a half of these goods remained in the ending inventory of SAI at the year, that is at the year end of 31st March 2023. In short, what they mean is that out of the goods SAI received from River, he never resold all of them. So meaning that he never realized the entire profit, which already River realized. Meaning that the profit of River is overstated by what SAI never realized. Because when River sold the goods to SAI at the 300, when River did what? Sold goods to SAI for 300, he made a profit of 20%. He made a profit of 20%. But on SAI, a half of the goods are done what? Unsold. So meaning that here, we need to check the unrealized profit on the stock, on the goods in SAI. The profit which River realized, but SAI never realized, because he never resold all the goods. A half of the goods are unsold. So whereby we say that it's a half of the 300 times profit margin, which is a fifth. Remember, 20% is a fifth. That is how you get your UPS. That is how you get your UPS. And since this is a downstream sale, we'll be able to adjust this UPS in our profit and at the same time, inventory account. It will affect profit account and the inventory account. It will affect the profit account and the inventory account in the process of elimination of the profit, which is overstated in River. Number 5, included in the trade receivables, River is 80 due from SAI. So there's some amount which SAI is supposed to pay River. So, but in the books of SAI, the amount due to River was shown at 60 instead of 80. Why? Because SAI had remitted 20. SAI had remitted 20. So what on this scenario, what is supposed to be done when doing your adjustments? Remember that there's some amount which is supposed to be received from SAI to River, which is 80. But now in the books of SAI, it's showing 60 because he already has paid 20. He has paid 20, meaning that 20 was cash in transit. So cash in transit, it's 20. Because already River is saying that I'm supposed to receive 80. But SAI is saying I'm supposed to pay you 60 because I paid already 20. So meaning that 20 was cash in transit. So the outstanding balance is the 60. So this one we eliminate, disregard it. This one must be in the book. It's not supposed to be taken to the next financial year. How will I clear this from the books? Credit receivable, debit payable. Debit payable, credit receivable account. For 20, record cash in transit. So the cash in transit you are supposed to record by debiting bank or cash, bank/cash, then our debtors must reduce. So you have to credit under receivable. You credit under the receivable. That is what's supposed to be done. Number 6, on 1st October 2022, River sold an assembly plant to SAI for 400 million, reporting a 25% profit margin on the selling price and netted off the profit against its cost of sales. Netted off what? Profit against the cost of sales. Against the cost of sales. So on that scenario, when there's a sale of a fixed asset, assembly plant, which was sold from who? Which was sold from River to Sai at 25. He recorded a profit of 25%. So this is an assembly which has been sold, sold from River to who? To Sai at 400. River made a profit of 25%. Was it on margin or was it on margin or was that is what we need to check before I continue explaining anything. So the 25 profit margin, 25 profit margin. So meaning that when River sold the assembly plant to Sai, he made a profit, but they never said Sai resold. Sai will never resell it, never resold. Never resold the plant. This is a fixed asset, sale of fixed asset, fixed asset. So on this scenario, meaning that the profit which River realized, this profit which River realized was never realized by Sai, meaning that this profit is overstated. The profit in Sai is overstated. Here we have profit overstatement. We have profit overstatement. We have the profit overstatement. So if there's profit overstatement, what am I supposed to be done? What is supposed to be done? This profit must be eliminated because this company never did what? Realized the profit which River realized. And that is what we call UPFN. And realized profit on fixed assets, which is all about the transfer value. Transfer value is anyway 400. They transferred at 400 times 25%. That is what you will get is the unrealized profit on fixed assets. So we need to eliminate this profit in the books of River by doing what? By debiting retained profit. We debit retained profit. We credit what? We credit property, plant, and equipment. But remember, when I will be doing my statement, I will not be using double entries. For now, what I'm doing, I'm just trying to explain just for your understanding. Because when I will be doing my statement, I will just minus direct in the statement. I'm not going to open any T account. I will not open T accounts. But now the deductions and subtractions which will be done, the reason behind them is this. So the debits and the credits. For now, I'm explaining to create a meaning when I will be subtracting some adjustments and adding some. So then they said something in that additional information. They said something in that relevant additional information. There's a sentence there in note 6, the last one, where they said this depreciation plant at the rate of, the group means that parent and subsidiary, River and Sai. The word group means parent and subsidiaries, So they are saying that the group charges depreciation on plant at the rate of 20% per annum on cost, on full year basis, in the year of asset purchase and none in the year of disposal. So when there was sale of these fixed asset from this company to this one, both of them, they subjected the same asset to a 20% depreciation. Both, the group, parent and subsidiaries. So what am I supposed to do? This one, we call it depreciation overcharge. Depreciation overcharge. So depreciation overcharge, you compute it based on your UPFA, the one you will get here, the answer you will get there, times the 20%. So depreciation overcharge. Where are you supposed to adjust your depreciation overcharge? When they did a depreciation overcharge, meaning that they understated the value of the asset. Our asset account was understated. At the same time, the profit account is understated because they did a depreciation overcharge. Our profit is understated and the asset is understated. So what we do, we debit PPE, and credit what? Credit the retained profit. You credit your retained profit account. Very simple. You can see how this question was very simple. Kazi rahisi kabisa. The 20 marks was just easy thing to score. There's nothing I've not explained so far, because number 7, they are talking about impairment test carried out on 31st March 2023. Revealed that neither the goodwill on acquisition nor the investment in associate had been impaired during the year. They are telling you that there is no impairment. There is no impairment. Number 8, none of the group companies paid dividends. So number 7 and 8, those are irrelevant. There's nothing there. Because they're just telling you there's no impairment and no company paid dividends. So before I start the presentation of the 2 required statements, I have said that we have started online classes, the Zoom classes, where we do more work. More work is done in the evening classes, the Zoom classes. So for you to join, it's very simple. Just contact me. My number is 07 28 760 546. You can WhatsApp, you can call me. We agree on the way forward. Now we start the classes. And at the same time, for the guys who are following through YouTube, I know here, I know that so here, I know that the students following. So I can see students following here. So make sure that you give me a subscription. You give me a subscription. You give me a subscription. You give me a subscription as we start. So now we are ready to present. We are ready to present the relevant statement which was required. So let me open this relevant question so that we will be able to do it. So it was April. So we have 2023 April financial reporting question 2. So now we can be able to do the presentation. So we start from the presentation of an income statement. That is the statement of profit and loss. Then we do what? We do the statement of financial position. Mostly in our next session, in our next live session. For now, I will be able to do the first part only. Then in our next session, I will be able to do the second part. So the first thing you could have done is all about doing the analysis. Remember that the River acquired who and who? He acquired Sai, and he acquired Tutu. He acquired Sai and Tutu. So 80%, 40%. So the next thing is all about checking the time. Were these entities, the subsidiary and associate, were they existing for the entire year? Our financial year ends on 31st March 2023. It starts on April 2022. So Sai was acquired on July. Then Tutu was acquired on January. So Sai was acquired on July. That is 1st July 2022. The entity was acquired on 1st January 2023. So meaning that this is Tutu, this is Sai. So Tutu was existing for many months. Tutu was existing for 3 months. And what about Sai from July? So from July to December is 6 plus the 3 months of 2023, meaning that this one was existing for 9 months. So meaning that Sai is a 9 months subsidiary. 9 months subsidiary. Tutu is a 3 months associate. So once you know that, you can be able to do your presentation very easy. Because the next thing I will do here is all about now writing the heading by saying River Limited. We talk about consolidated statement of profit and loss, consolidated statement of profit, consolidated statement of profit, consolidated statement of profit or loss. That is for the year. For the year ended. So our financial year was ending on 31st March 2023. 31st March, that is 31st March 2023. So here we start from revenue. We start from revenue. So for the revenue, remember that we take the parent plus subsidiary, you minus the intergroup sales of goods. So in this scenario, you know that it's 4190 plus the subsidiary, but the subsidiary was existing for 9 months. So we have to apportion the items of SI. So here we multiply with 2600 minus the intergroup sales of goods. So these goods which were sold from river to Sai, that is according to note 3, the 300. So we are done with revenue. We go to the cost of sales. We go to the cost of sales. So the cost of sales, we say 2730 plus 9/12 times what? Times 1400. Minus this 300. Then now we add the unrealized profit on stock. Unrealized profit on, that is a UPS. So after minusing the intergroup sales, we check the UPS out of the goods which were unsold. Remember, the goods were sold from river to Sai. River made a profit, but Sai never sold a half of the goods. The Sai made a profit of, that is according to note 4, he made a profit of 20%. So that was a fifth. So this one will give me 30. So that is what I would be able to add back here, the 30. Then I have to check if there's depreciation undercharge and overcharge. Depreciation undercharge, this one arises due to revaluation. But we don't have revaluation. Remember they said the fair value of the assets and liabilities of Sai were equal to their carrying amount. So there's no revaluation. So we cannot be able to check depreciation undercharge. But there's depreciation overcharge due to the sale of a assembly plant. So first, you have to determine your unrealized profit on fixed assets. So the assembly plant was sold at 400. That is according to note 6. River sold it to Sai at 400, and River made a profit of 25%. So first we have to determine this. We need to determine that 400 times 25%. 400 times 25%. We determine the unrealized profit on stock. Unrealized profit on stock. The 400 times 0.25. That is 100. Then depreciation overcharge will be, you take your UPF, you take your 100 times the depreciation rate. So this one will be 20. So remember that in that note 6, they said that the group charges depreciation at the rate of 20% on cost. So that is okay. Before I read that statement, note 6, there's somewhere they said that they made a profit of 25% profit margin on selling price and netted off the profit against the cost of sales. Netted off the profit against the cost of sales. So what am I supposed to do if they said that? If they netted off the profit against the cost of sales, we are supposed to add back that profit here. The 100 is supposed to be added back. And at the same time, we minus what? We minus the depreciation overcharge. We deduct the 20. We deduct the 20. So we are done with the cost of sales. We are done with the cost of sales. So next, we continue with the consolidation of other items. So the consolidation of other items. So the consolidation of other items. So remember that once we take the cost of sales, we deduct from the revenue, we get the gross profit. That one, you know. That one, you know very well. So I will be able to get here. Once I do my computations, I will be able to get my gross profit. So the next thing is all about adjusting the other items. Right now, the other item is distribution cost. The distribution cost. So the distribution cost is all about 300 plus 9/12 times 200. After that, we have the admin. So the admin is what? Admin is 500 plus 9/12. 9/12 times 400. Sorry. Then now I could have introduced impairment, but they said there was no impairment. After that point, after impairment, we get profit from what? Profit from profit from operations, as they have said there. After the profit from operations, we have investment income. We have investment income. So investment income, it's all about 40 and 20. 40 plus 9/12 times 20. After that, there is a finance cost there. Finance cost, which is 80 plus 9/12 times what? 9/12 times the 60. But now, before we say profit before tax, remember now I have to introduce tutu. So from tutu, the parent will take 40% of the profit after tax. So a share of profit after tax in associate. So after tutu paid tax, the profit which is remaining, the profit after tax, profit after tax, the parent will take 40%, but for only 3 months. But for only 3 months. So the profit after tax in tutu, the profit after tax in tutu is 200. The profit after tax in tutu is 300. So meaning that what I will do here is all about saying 40% times 200 times 3/12. That is the profit the parent will take from tutu for the 3 months. Then I will say profit before tax. Profit before tax. That is what we'll get there. Income tax, we deduct of the parent and subsidiary, because already for the tutu, we have considered this as the profit after tax. So the only tax here to be deducted now is that of the parent and subsidiary, which is 180 plus 9/12 times what? Times 160. Times 160. So that we get profit after tax. Profit after tax. And after we get the profit after tax, remember that the rater will be able to share some profit to the minority shareholders inside. The 20% minority shareholders inside will be able to get something. So we say profit attributable to NCI. Profit attributable to NCI. And profit attributable. The balance now is, so the profit, after saying profit attributable to NCI, finally we'll be able to say now the profit attributable to parent. So for NCI, that is the only working I will do. You can see which workings have I done? Very few. I have not opened any T account so far. I have not done that. Never waste your time on that. Showing these classes, I show you how work is done, how these things are done in an easier way. Welcome your friends. Create awareness. Create awareness. Never waste your time in other platforms which will be able to waste your time. So come here, we handle these things professionally. So let's get now the relevant totals. So 2730 plus 9/12 times 1400 minus 300 plus 30 plus 100 minus 20. So this is 3590. So if we deduct that one from 5840, be able to get 2250. Then 300 plus 9 over 12 times 200. So this is 450. So this is a deduction. 500 plus 9 over 12 times 400. This is 800. So there's no impairment. That is what they said in the Rust, second Rust additional information. There's no impairment. If there was impairment, we could have gone ahead to do goodwill. But at the same time, we'll do goodwill for us to get the goodwill, which will be recorded under non-current assets in the statement of financial position. In the statement of financial position. So this is 1,000. This is 1,000. Then 40 plus 9 over 12 times 20 times 20. This is 55. So this is an addition, investment income. Then this one is a finance cost we subtract because it's an expense. So that is 8. So this is 125. Then share of profit 0.4 times 200 times 3 over 4. That is 1 over 4. That is a quarter. 3 over 12 is like a quarter. So this is 20. Remember, this is an income to the parent. We add 1,000 plus 55 minus 125 plus 20. So this is 950. 180 plus 9 over 12 times 160. This is 300. So we deduct. So 950 minus answer, 650. So up to this point, we'll be able to do this. Profit attributable to NCI as a simple working here. You can be able, I think, to use this area. We do profit attributable to NCI. So profit attributable to NCI. This is the only working I think I will be able to do. So we start from the profit after tax. Profit after tax in SAI, the subsidiary. So remember that the profit after tax in SAI was a subsidiary for 9 months. The profit after tax in SAI is 400. So we need to adjust this profit before we share anything to the minority shareholders. So we need to adjust this profit. This profit might be overstated or understated. Why? If there was an unrealized profit on stock, UPS, if sales upstream. If sales upstream. If we have that, we deduct. If the subsidiary sold goods to the parent, if the subsidiary sold goods to the parent, and the parent never realized, or the profit, the subsidiary realized. So meaning that the profit of the subsidiary is overstated. That is why we deduct here. But we don't have this upstream sale. The sale was downstream, the sale of goods. Another thing we raise is depreciation. Depreciation overcharge. Depreciation depreciation undercharge. That is what we deduct. Because now if we did a depreciation undercharge, our profit was more. We deduct. There was no undercharge. We can only have a depreciation undercharge if there is the presence of a revaluation gain. Add depreciation overcharge. Because now if they did a depreciation overcharge, our profit was understated. There was this depreciation, this 20, depreciation overcharge of 20. And finally, if there was impairment, loss, we could have deducted. But impairment, if we did goodwill, remember goodwill is the one which is impaired. If we could have done our goodwill using full method and there is impairment, based on that, that is when you deduct here. But there was no impairment based on the goodwill, which will be done later, because they already directed us that there was no impairment. According to note 7, they gave us a direction. So Remember that if I use my calculator well, I will be able to get my answers. That is the obvious. That is the obvious. So this is 300. So this one will be 320. Adjusted profit. The adjusted profit. Adjusted profit. So now the NCI profit will be 320 times 20% times 20%. Because the NCI, remember the parent acquired SAI 80%. So the remaining was 20. So 320 times 0.2, I will be able to get my 64. So that is what I will be able to record here. I will be able to record the 64. So that the profit attributable to parent will be 650 minus 64. 650 minus 64. So this one will be 586. This first part of the question was having 8 marks. The examiner was in need of any 4 correct entries. Any 4. How many are these? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. But he never needed the 10 for you to get 8. He needed any 4, any correct 4. So that they multiply with 2, you get your 8 marks. Simple like that. You need only 4. 4 is like adding this, it's like just doing distribution admin. You do finance, even investment income. You get your 8. How can you fail on this scenario, guys? How can you say that the FR is tough? It's very easier. That is the first part of the question. You can see how easy it was. So as you continue watching, remember to give me a subscription. Never just watch, because I realized that 50% of the students who watch these videos under my platform are not my subscribers. Subscribing is free. I know some of the students or some of the followers, you forget to subscribe. But now I'm giving you a reminder from now going forward. Kindly give me a subscription. We need to enter the 10,000 mark. We are at 8,000. So at the same time, remember that these classes which are starting, students are still enrolling. So you can also enroll to join my classes. That is the evening classes from 8 p.m. to 10 p.m. So there's a timetable. There's a WhatsApp group. Once you commit, once you talk to me, you commit, you will be added to the group. You will get pre-recorded videos, all of the topics. Lecture classes twice a week per unit. Lecture notes, which you can be able to use, so that you will be able to overcome this paper. Never fail for lack of few coins. For lack of few coins of training my class. Never do that. So I'm considering doing the second part so that I can be able to say that this question is complete. So that I can say that this question is complete. So let's look at the second part of the question. So the second part of the question was all about statement of financial position. Statement of financial position. Again, it was having 6 marks and 12 marks, but they needed any six entries. Any 6 entries. So again, I will say River remitted. So River remitted. Consolidated. We have the consolidated statement of financial position. As at what? As at 31st March 2023. As at 31st March 2023. So we start from the non-current assets. So for the non-current assets, we have property, plant, and equipment. So in this scenario, we say 2070 plus the subsidiary, 1290. Now here you don't prorate the subsidiary. Remember that the subsidiary was there for 9 months, yes. But when doing the statement of financial position, it's prepared on a specific date as at the end of the year. So even if the subsidiary was existing 1 month, for 1 month, as a subsidiary of the parent, we don't prorate the items of that subsidiary when doing the statement of financial position. We only prorate for the income statement because an income statement is prepared for the year. So if there was revaluation, you add, we always add revaluation minus depreciation undercharge due to the revaluation itself, minus UPFA, which is 100 plus depreciation overcharge. So this is UPFA depreciation over. We are done with property, plant, and equipment. We move to the next one. So there's investment. So investment in SAI, we determine goodwill. Then investment in Tutu, we say investment in Tutu. So this is, we will use equity method to work for the investment in Tutu to be done later. So we go to the current assets. We go to the current assets. So for the current assets, this question was very easy, by the way. Inventory, 530 plus the subsidiary, 390. So yeah, you minus UPS, which was, that was UPS. There was UPS of 30. If there was goods in transit, I could have added goods in transit. Because now if there's goods which were sold from one end to the other, and they were never received by that other entity by the end of the year. Remember, we need to record as if they were received by the end of that period. So we debit inventory, we credit payables for the goods in transit. Then trade receivable. For the trade receivable, 640 plus 470. Remember I said we disregard the 60 and 20. You remember there was that amount from SAI to River of 80. But SAI is saying it's 60 because he had already remitted 20. So I said the 60 must be disregarded. You deduct under receivable and payable. 20 we record. We add under cash and we minus here because it has already been paid. Then we move to the next item. That is financial. Asset at fair value. Asset at fair value. Through profit and loss. Through P&L. Profit and loss. So here, it's 300 plus 150. Then we need cash and bank balance. So cash and bank balances, 360 plus 200. Then remember that this 20 must be added here. So up to that point, we have total assets. Total assets. Then we move to the equity and liabilities. So the equity and liabilities. So for the equity and liabilities, we have the ordinary share capital. Ordinary share capital, parent company. This is 2,500. 2,500. Share premium. Share premium, parent only. You pick that figure of the parent only. Parent share premium, 500. Then after share premium, there's retained profit. We do a working. Then there's something I will introduce here, non-controlling interest. We'll be able to check the capital of the minority shareholders. Again, there's a working needed there. Again, there's a working needed there. Then we move to the non-current liabilities. So non-current liabilities are just 12% loan notes, 12.5. Yes, 12.5% loan notes, which is all about 640 plus 480. You can realize that most of the items in this statement of financial position, it's all about adding parent plus subsidiary. Parent plus subsidiary. Then here we have deferred tax. So deferred tax, that is 260 plus 100. Then current liabilities. So for the current liabilities, we have the trade payables. So for the trade payables, 420 plus 330. And now you minus this 60, this one. Remember, we have credited here, then here we debit. Then if there was goods in transit, we have debited here, we credit here. So meaning that once you add there, you add here, goods in transit. So remember, this is debiting, adding, and adding here is crediting. Goods in transit, but we don't have goods in transit. They are not present, we don't have them. Then current tax is 160 plus 90. So we have total assets and what? Total equity and liabilities. So on this case, on this scenario, remember that you can get the 12 without more workings. Up to what we have done, we have the 12 marks for your information. So this is 3280. 530 plus 390 minus 30, 890. 640 plus 470 minus 80, 1030. This is 450. This is 560 plus, this is 580. And then 640 plus 480. This is 1120. 360. 420 plus 330 minus 60. This is 6 what? 690. Remember, there was no goods in transit, so I can just say it's 90. Then 160 plus 90, 250. So this question, this statement needed, you get 12 marks, but in which way? They needed only any six entries so that they multiply by 2. So these are more than 6. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 11. So even before I do these workings, you have your 12. Even before I do this. So in your exam, it's not even you will have done those workings. It's not a must. It's not a must. You could have scored the 12 marks and the 8 marks, totaling to 20 out of 20 for that question too, without a lot of work. And never waste your time opening tier accounts. No examiner will mark workings. Anyway, to show you that the equation can balance, let me do the 4 workings. Just to prove that. And so we are back. So we can do goodwill. So remember that goodwill is all about purchase consideration. Purchase consideration minus share of net assets. Share of net assets. So I said we'll be able to use full method. Why? We'll be able to use full method because you are told in addition information number 2 that the group policy is to measure the non-controlling interest at the proportionate share of net assets. So we need to get the net assets first. So net assets of psi. For me to get the NCI, fair value of NCI, I will use the net assets, the share, the 20% of net assets, 20% of net assets. That is what will give me the fair value of NCI. That is what will give me the fair value of NCI. So net asset, we need ordinary share capital of psi. Ordinary share capital was 500 plus what? Share premium 200. That is from the statement of financial position plus retained earnings. But now the retained earnings, but this is ordinary share capital, share premium. But now the retained earnings, it must be the one as at the time of acquisition, as at July 2022. As at July 2022. Remember, our financial year ends on the 31st March 2023. It starts on 1st April 2022. So we need the retained earnings as at the time of acquisition. So for the 3 months, because this is 9. So we need pre-acquisition period as at this date. So for the statement of financial position, we have retained earnings of 800 as at the end of the year. From the income statement, the profit for the year in psi, is 400. It's very easy to get now 3 months. What I will do, I will take 800 minus the last 9 months profit. I will apportion my 400 for the rest. I get the profit for the year for this. I deduct from 800 so that I get for the first 3 months. So this one will give us what? So 9/12 times 400. So 800 minus answer. So this is 500, meaning that by this time, the retained earnings was 500. That is what I need here. Meaning that the total year will be 1200. That one will be 1200. So how would I be able to get that favor of NCI? How would I be able to get the favor of NCI? So after getting the 1200 total net assets, see, I say 20% of that. So that is what gives you the favor of NCI. That is the proportionate. That is what they said in note 2. The group's policy is to measure the non-controlling interest at their proportionate share of net assets. Proportionate. So that is what I've done. So this is 240. The favor of NCI. The favor of NCI is 240. So going ahead, I will be able to get my goodwill here in an easier way, in an easier manner. So I will have two columns, that of the parent and that of the NCI. I will talk about purchase consideration, which is given in note 1, which was in cash. So the purchase consideration of 1100. Then favor of NCI, which is the one we have computed, 240. Then rest, share of net assets, share of net assets. Remember, we got already the total net assets 1200. So 80% of 12. We have just arrived at the 1200. I think you remember how we arrived at it. So this one will be 240, giving us 0. Then 0.8 times 1200. This is 960. So 1100 minus answer. This is 140, meaning that our goodwill, total goodwill will be 140. That is what I will record here. 140, 40. Then we do investment in 22. We do investment in 22 using equity method. Investment in 22 using equity method, International Accounting Standards 28. So here we start with initial cost of investment. So when we are talking about investment in 22, the equity method is whereby the associates are initially measured at cost. Then we are discharged with profit or reserve, we minus impairment. That is what we are going to do. You measure the associate with the initial cost, add back profit or the reserves, deduct impairment. So initial cost of investment is the purchase consideration given in note 3, 500. Then after that, add back profit, share of post-acquisition profit, share of post-acquisition profit. Share of post-acquisition profit. Share of post-acquisition profit. So on this night, I will say 40% times what? Remember that in this called 22, the profit for the year is 200, but we need the post-acquisition period, which is 3 months. Profit for the year is 200, but we need the post, which is post-acquisition period. Post-acquisition period is 3 months. So remember, this is not 400, but 40%. So for the share, 40%, 0.4 times 200 times a quarter, because 3/12 is a quarter. So this is 20. So that is 20. Then after that, remember that after that, Remember that if there was any impairment, we could have done what? We could have deducted. So meaning that we could have gone ahead to compute goodwill of 2. But they said in second draft additional information that there was no impairment. So meaning there's no impairment to deduct here. So this is 520. So this is 520. We do the rest too. NCI and retained profit. The retained profit and NCI. The retained profit and what? NCI. So remember that for the NCI, this is the only one I will open a T account. Non-controlling interest, NCI. You just write in short, NCI. So remember that it's inside the 20%. So what we do here, we start with net assets. Ordinary share capital. So remember that it's 20% of the net assets inside. So the ordinary share capital inside is 500. 20% of 500 is 100. Then there was share premium. 20% of the share premium inside. Share premium inside is 200. This one gives us 40. Retained profit. Remember, this one you pick direct the way it is from the statement of financial position, which is 800. So 2 times 8 is 16. This is 160. There was no any reserves, and there was no any reserves. So if there was reserves, like revaluation reserves, you include here. Then you will come and check the goodwill of NCI. It was 0. Goodwill of the NCI. It was 0. We computed just a few minutes ago. There was no goodwill of NCI. The other column, when we did goodwill, there was that column of the parent and NCI. Then depreciation overcharge. There was depreciation overcharge. It was a 30 or what? Depreciation overcharge. It was 20. You remember when we did UPFA? UPFA was our unrealized profit on fixed asset was 100. And they say depreciation, the group is charging at 20%. So 100 times 20, it was giving us 20. So that is the one we use here. So this one is 4. Then now, what am I supposed to include here? UPS. But now this UPS, if the sale was upstream. But the sale of goods, remember, were downstream from river to side. It was not upstream. So if upstream, that is when you include this. Because we are dealing with NCI inside now. If side sold to the parent, then depreciation undercharge. There was no undercharge because there was no revaluation. We were told that the fair value of the assets and liabilities of SAI were equal to their carrying amount. Then we talk about impairment, if there was impairment loss. But if the goodwill computed, we used the full method. That is when you record that impairment, if it was present. Meaning that we can be able to get the balancing figure. Our balancing figure is 100 plus 40 plus 160 plus 4, 304. So balancing figure, 304. So 304. So that is what we record here. Finally, as I request that if you are my follower, if you are following this video and you are not subscribed, remember to do that. Why can you be following and you are not my subscriber? By the way, make sure that you give me a subscription. We passed the 10,000 mark. We are adding to the 10,000 subscribers. And at the same time, guys, the 10,000 students, I mean that why can't even half of you guys join my live classes? You will be able to benefit more in the live classes we are doing in the evening classes. In the evening hours, sorry. Students are still enrolling so that we can start. So make sure that you enroll so that we start this journey towards August sitting. Never be left behind due to lack of few coins. Just call me and we talk. My number is 0728 760 546. Now let's do the last part of the question so that we balance it. And we call it a session for today. Also, you can drop a comment, what you think, the work we are doing here. Give me a like. The more you like this video, the more you like the live sessions or the videos, the more YouTube will be able to give it a first option to be shown to many people. So give me a like. So we have a retained profit. I will be able to do it in a direct manner, in a simpler way. I will not be able to open a T account. I will just do it in a simpler way by saying that the retained earnings of Liver Limited is 1020. What am I supposed to adjust again is this share of post-acquisition profit. Share of post-acquisition profit. Share of post-acquisition profit. So that of Sai Limited, that of Sai Limited, and that of who? And that of River. How would I get the post-acquisition profit of Sai? Remember, the balance carried down, the profit is 800. The profit is 800. The profit is 800 as at the end of the year, minus the one as at the time of acquisition. By the time of acquisition, remember we did the retained earnings. Remember when I analyzed it this way, I said there was June, here we have 800. Remember we are talking about side. The profit for the year was, remember this one was 3 months, this one was 9. The profit for the year was, I think, according to my question here, the profit for the year inside was 400. So we went ahead to look for the profit as at the time of acquisition. As at the time of acquisition is what? So we just say, I just need anyway, post-acquisition period. It's even easy to get this. Because once I know this, I will be able to minus 800 from this, I get this period. I get this period. So meaning that when I wanted the 3 months, I said 800 minus 9/12 times. 9/12 times what? Times 400. This one gave us what? This one gave us, so 9/12. 9/12 times 8 times 400. So this one gave us 500. So this period is 500. Here is 500. So I need this period. How would I get it? So I would take 800 minus 500. I would be able to get my post-acquisition period of 300. Let's push this towards the end there. So that's the share. The share. So meaning that the share is the percentage. So now the percentage of the parent in size, it's 80%. So 80%, 300 times 80%. So this is 240. That is 240. Then the next one is all about liver. Not the liver, but 22. I would get for 22. Remember the profit for the year. I say 40%. Profit for the year from the income statement of 22 is 200. But I need the post, which is 3 months. Which is 3 months. So this one will give us what? We did somewhere this. We did when we were doing the investment in Tutu. We did this. I think we got something like 20. So those are the things you add back. And again, you add what? You add the depreciation overcharge, the share of the depreciation under overcharge. So what the parent will be taking or what will affect the parent's profit is 80%. 80% of the 20. Remember, I said depreciation overcharge. It affects the asset. It affects the asset and at the same time profit. So this one will be 16. Then now, what will reduce this profit? The unrealized profit on stock, because a profit was overstated in one entity due to the sale of goods to that entity, from River to Sai. So Sai never realized the entire profit which River realized, because Sai never resold all the goods which he received from River. So meaning that the River's profit is overstated. So we minus that. Then finally, even the profits, the unrealized profit on fixed asset. Well, that one again was understating the profits. The sale of assembly plant from River to Sai. So Sai never resold that asset, meaning that the profit of River is overstated by what Sai never realized. So we minus. So up to that point, we can say 1020 plus 240 plus 20 plus 16 minus 130. Get 1166. So that is what you put here, 1166. So let's check if our equation is balancing. 3280 plus 140 plus 520 plus 890 plus 1030 plus 450 plus 580. This is 5990. 2500 plus 500 plus 1166 plus 304 plus 1120 plus 360 plus 690 plus 250. So there's something I need to confirm according to my additions. So that we check if we did a mistake anywhere. So we check where maybe where there's an error, because everything which has been done, we have done according to the requirements of the entries which were supposed to be done. So on this scenario, so remember I'm checking on the statement of financial position. Because this one is a this is 3280. Yeah? We add with 140. We add with 520. We add with 890 plus 1030 plus 450 plus 580. It's okay. So it's my addition which was having issues. There's no mistake we have done. Though this is supposed to be 6890. It was my calculator which we did a mistake in adding. Because even I repeat again, 3280 plus 140 plus 520 plus 890 plus 1030, not 20, 1030 plus 450 plus 580 Yes, it's 6890, correct. So meaning that even this one is 6890. If I can repeat adding 2500 plus 500 plus 1166 plus 304 plus 1120 plus 360 plus 690 plus 250, correct? That is how you are supposed to balance this. But in an exam, never waste your time to balance it. You remember I showed you the way you are supposed to do this question in the first stage, so that you get your entries without the workings, without goodwill, investment in tutu, without retained profit, without non-controlling interest. And you will be able to score your 12 marks. As we come to the end of this session, I repeat again that these classes I do online, join those classes. We do more of questions. We introduce a topic. Once we introduce a topic, we go ahead to do questions. It's like a normal class. There's no difference. It's only that now it's virtual. So for you to show interest, let's talk. Let's converse. This is my number. Let's converse. No matter the unit you need, you can be able to be sorted. So use this number to WeChat on the way forward. On the way forward. And remember that the earlier the better. Wanasemanga mapema ndio best. Mapema ndio best. And remember to subscribe. Never be watching without subscribing. Thank you. Welcome in the coming sessions. And all the best for the guys who did your exam, who are waiting for the results, which will be released soon. Bye.